today, this is the last class here, discounted dividend and multiples-based valuation. This is going to be kind of short too. So today we're just going to go over the discounted dividend model, the multiples valuations, and then just general tips on how to weight the valuation models. So the first thing to understand like discounted dividend models is you need to understand the way that perpetuity growth works. And I'm sure that you've seen this in like corporate finance where Dr. Maya did this. But you just take the dividend in the next period, and you take the discount rate or the required rate of return, so that's the weighted average cost of capital in our case, minus the rate that the dividend grows at. And then when you calculate that, you'll get the fair value of the stock, assuming the dividend just grows at a constant rate forever. So the way that plays into the discounted dividend model is usually what you do, you forecast the first, I did about 5 periods worth of dividends because when we forecasted the balance sheet and everything, we forecasted 5 periods worth of dividends. And all I did is took those and I used the present value equation to discount those for each of the 5 periods, add that up, and then to kind of finish off the valuation model, you just take that perpetuity, that like assume it grows perpetually at some rate, or you can assume that it has no growth, so you just divide it straight by the discount rate, and that gives you like the fair value of the stock with a dividend that never continues to grow, but it pays them forever. So that's kind of how you do like a 2-stage discounted dividend model. So if you look on this spreadsheet, I have so I just linked them all over to the forecast. I took all of the dividends for 2018 through 2022. I put the growth rate under there just so I can kind of see to make sure that it was right. And then I took the required rate of return, which is 4%. And the way that I calculated the terminal value for Coca-Cola is I just assumed no growth. So I just divided the last year's dividend by the discount rate. And that's like saying that's going to pay the $1.75 forever into, never grow. And that typically makes sense for most like mature companies, because that company cannot continue to grow its dividend at 3% forever. And we can actually see that if we look at residual income. When the company's growing at the rate of the economy, but it tries to grow its dividend at 3%, eventually its dividend here will start to outpace its earnings. So that's why that's part of the assumption for no growth is when you think about it logically, if the dividend is growing faster than the rate of the economy, the company really can't do that because they're going to go bankrupt. And then to get your kind of target price, you just add them all up. So present value of all the dividends, and then plus the terminal value, you get 46.53. I think the company's at 53 right now. So this is another one that shows that it's about fairly valued, accounting for its dividends. So that's like a good sanity check. And on some companies, the discounted dividend model won't work at all. I think when we did Brinks for the CFA pitch, not even close. It said it was like $4 a share when the company was like 70. If the companies really never grow their dividends, they don't pay out a lot. Like they pay out they have a low payout ratio, like 10% or something. And payout ratio is just the percent of net income they're paying out as dividends. So they only pay out like 10% of their net income or something small. You're not going to get like a very accurate picture of it because that's not their management strategy. Typically, management has like 2 strategies for growing their share price. One is paying out a ton of dividends. The other is paying back to investors by buying shares back. So some companies can afford to do both. Like if you look at Apple, they can afford to pay dividends and buy back billions of dollars worth of shares every quarter. But like a small company like Brinks, they're typically just going to buy back their own shares, and that's how they're going to pay it back to you. Next, we're going to look at kind of the multiples. And this one's also this is super simple. In the income statement and balance sheet, we forecasted 5 years out. For this, we only need 1. What we try to do with this is you're trying just to get a 12-month price target. So you're going to take 2019's forecasted EPS for Coca-Cola, and then you'll go over to the Bloomberg terminal. look at this EQRV screen and make sure that the comparative source is the global industry classification standard. The level is sub-industry, so the soft drinks industry in this case. It gets you the screen with the total like industry average, price to earnings, enterprise value, EBITDA, EBIT. So all these multiples are used to value it. So in discounted cash flow we use EV to EBITDA, but for the 1 year price target, price to earnings, just take the earnings per share we forecast next year and multiply it by the industry average. And it'll kind of tell you where they're going to be compared to the industry in the next year. Same with price to book. You'll calculate the book value per share and just multiply that by the 4.5, which is the industry average. So if we go back to the spreadsheet, you can see that I did that. I did it for 2018 too, so you can kind of see like where its value is. So 35.14 for the EPS in 2018, and in 2019, 37.74, 78 for price to earnings. And in 2019, the other thing that you do is I use the present value equation again, just to discount the $39 that's like the projected share price to what it's worth in today's money. So you use the WACC as the discount rate again, and it'll take it down a couple dollars. Same thing with price to book. To get the ending book value per share, all you're going to do is take the you'll take the total equity on the balance sheet. You'll take the total equity on the balance sheet, and then you're going to divide it by the number of shares. That's your book value. To get the next year's book value, all you're going to do is you're going to add earnings per share, subtract dividends. The change in retained earnings is your change in book value, and then multiply that by the multiple. And then once again, present value to get the years to today. And like these values for this company aren't surprising because their price to earnings and their price to book are higher than the industry average, so you're probably going to get something a little lower. This this method it's used actually pretty often in valuation. When I was reading a research report today on Union Pacific, and that's the only way that JP Morgan valued it. All they did is they didn't use the industry average price to book or price to earnings. They kind of they had their own way of calculating the multiple they think it should trade at. That's something that I probably wouldn't recommend doing unless you really know the industry. But that's like another way to kind of do it. And they forecasted their earnings as well and then multiplied it, and that's how they ended up where they were. So this is like sometimes people use this to weight into models a lot, especially for mature companies like this usually work better. Like anything like Tesla or whatever that's going to generate negative earnings, this probably is the best way. Or if the earnings are still relatively low, you're not going to get anything that's like remotely close. So when it comes down to, so now you kind of have an idea of how all the models work and what they are. Basically, you just have to weight them. Most people use a combination of either 2 or 3. The most common combination is, so they use 2 and they do a 70-30 mix. And like the most common 2 to combine are a discounted cash flow and a discounted dividend model. It's like that works in most scenarios for most companies. But the whole thing with weighting it is you have to think like what fairly represents this company. Like if you're valuing a REIT and most of it, you think that the dividend that it pays is the most valuable thing and you want to show people that, you're probably going to want to give that like 70% of the weight and then something else 30%. Or if you're valuing like AMD or something and you think that its future like earnings growth is like the earnings growth next year is going to be great and you want to show people that, you might want to go 70% price to earnings. So it totally depends on like what you want to show everyone. You don't have to go 70-30. You can go 50-50, 60-40. It just comes down to what, from your research on the industry, what are the most important things that someone investing in this business like should think is part of its value. That's really all it is. And with that, we're pretty much done. That's all of it.